this point in the day. Let's shift our focus back to getting more perspective on markets. Varun Lohchab is head of institutional research at HDFC Securities, and he's joining us now. Varun, good to have you with us here. Thank you very much for your time. How does the RBI pause change things up for you and your research team, Varun, if at all, in terms of how they are looking at sectors under coverage, stocks under coverage?
Yeah, good morning. The pause has definitely come in as a positive surprise, while it was not completely unexpected, but it's definitely, it's a positive move in the current global context. And I think the main fear for FY24, which we had and probably everyone had, was the downside to the growth estimates, both globally and in India. And the continuous rate hikes was starting to dent demand to a certain extent in many sectors. So I think this pause will definitely give time for economy to absorb the rate hikes which have happened in the recent past. And in that context, some of the sectors like real estate, the upcycle could prolong, which has been our hypothesis. NBFC sector can make a bit of comeback, given the fact that right till now it was clearly in favor of banks, one-sided vis-a-vis NBFCs. Now I think NBFCs will also be able to compete well. So I think overall it's a positive for the economy, and if inflation doesn't spike up significantly, if crude remains in this zone of $80 to $90, then I think this pause could continue for a while. So FY24, clearly it reduces the downside risk to estimates. If you look at our house estimates were anyway lower than consensus at around 12%. We don't think this pause will make us upgrade those estimates, but the chances of further downgrades, which we had even on our estimates, I think they stand reduced, which is a positive.
Okay, got that. Varun, thanks for joining us. This is Pavitra. I know you have been positive on the capital goods, industrials, infra theme for a while. Is that still something that you stick by? And is there any kind of shift in what you're looking at now?
Yeah, I think more or less our stance would still remain the same. In fact, some of those sectors are more rate sensitive, so they would tend to benefit. So sectors that we have been positive on is one, financials. Within that, till now it was mainly banks. Now I think some of the NBFCs could also start outperforming. Apart from financial, capital goods, infrastructure, power, these have been, and real estate have been some of the sectors where we have been positive on. I think they should stand to benefit from this pause in interest rates. In terms of the defensive sectors, IT, we are still underweight. We believe next 6 months demand visibility is low. So there is no real reason for us to be significantly overweight IT. Consumer, again, we are underweight. We believe urban consumption is going to look a tad bit weak because of the high base of last year. We don't think there are any big red flags on urban consumption, but at the margin, it's not going to surprise you positively, and valuations are stretched out there. Consumer staples tactically look better for this year, given both growth and margin outlook compared to consumer discretionary. So consumer staples could be looked at, and pharma could be looked at within the defensive sectors compared to consumer discretionary or IT. So that has been our broad call, and we don't see any thing changing meaningfully out there.
On financials and banks, Varun, it's like a consensus. Everyone likes the space, right? But everyone also agrees that the only way it'll do well is if flows come back, because of exactly that reason, that it is overweight in most portfolios. So it's not so much a call of whether the businesses are doing well. They are, as the pre-quarterly numbers all show. Valuations are also, it's perhaps one sector where valuations are okay. I mean, they've been okay even when the market was expensive. But it's more a technical kind of a question. And the fact is that most people are overweight the sector. Will you make large money here, in your opinion, Varun, with a 1.5 year perspective?
Not really. Actually, in our model portfolios, we have not been overweight the sector. So we have been neutral the sector, but within the sector, I think the stock calls matter a lot. It's a large sector which is not very expensive, but it's not very cheap either, given the fact that earnings, we are sitting at sort of peak earnings out there. So I think people tend to forget that, when they are looking purely at valuation. So from that perspective, we are not significantly overweight, but it's a sector where you can get returns in line with earning compounding, which would even from these levels would be close to low double digits, early double digit kind of earning growth. That's our expectation. But within the sector, there was a lot of divergence in terms of valuation of certain stocks like ICICI, SBI, Axis were looking very attractive a year back. They still are okay, but not as attractive now. So from here on, I think one should have slightly more moderate sort of return expectations, financials and banks. And as I said, probably NBFCs could outperform banks over the next 6 to 9 months now, given the valuations in NBFC space looks tad more attractive in certain pockets.
Okay, and Varun, what is the kind of earnings growth that you're factoring in for the Nifty, since we're getting into Q4 next week as well?
So overall for the year, we believe we'll end at around 7 to 8% for our coverage universe, which is beyond Nifty. So around 7 to 8%, and this number we are expecting it to inch up marginally to around 12% next year. So we are in that high single digit, low double digit sort of earning growth sort of a trajectory. Our view on the markets, therefore, at the start of the year was that we would be somewhere between +5 to -10% kind of a return, and in most likelihood we'll have a negative probably return in the calendar year. First quarter itself has seen around 4 to 5% decline. So the absolute decline from these levels also looks limited now to the extent of maybe another 4-5%. But at the same time, the upside also looks capped to a maximum of 5 to 10% from here. So it's going to be a range-bound market. It's again going to be a stock pickers market, with stock picking even more difficult than what it was last year.
So would you mind, Varun, sharing, say, 3 or 4 top ideas where you think there are prospects for best absolute returns from here?
So it spans across sectors. So like NTPC we like in the power sector, within banking, while SBI and ICICI are sort of consensus buys. Apart from these, we like Axis Bank. From current valuations, even Bandhan Bank now we believe could be a dark horse. L&T and Cummins have been our top picks in the cap goods space. They continue to do well. In real estate, we like DLF and Oberoi. We believe they still have some upside room left from a 12-month perspective. In mid caps, we have MCX as one of the buys. We have NCC. We have it spans across sectors, but these would be some of the top conviction names which are part of our model portfolio.
Okay, all right, Varun. Thanks very much. That's helpful. Appreciate you joining in, and speak with you soon again. Thanks indeed. Well, that's Varun Lohchab of HDFC Institutional Equities with some